SPY versus VOO. Launched in 1993, SPY is the largest ETF in the world and the first ETF available to U.S. investors. Managed by State Street Global Advisors, the $600 billion SPY is highly liquid, with some of the highest trading volumes and liquidity among ETFs. Its long-standing presence makes it a go-to for institutional and retail investors alike, and it's often used for quick market exposure or hedging due to its strong market liquidity. Introduced in 2010, VOO offers the same exposure to the S&P 500 but with lower expenses, which has made it an attractive option for buy-and-hold investors. VOO's lower expense ratio and long-term orientation reflect Vanguard's mission of making low-cost investments accessible to all investors. VOO has grown significantly in assets and popularity, especially among retail investors, and is expected to surpass SPY's massive AUM by 2025. Similarities. Both SPY and VOO track the S&P 500 index, meaning they hold the same F500 large-cap U.S. companies in approximately the same weightings. Both funds provide investors with broad market exposure to various sectors, including technology, healthcare, consumer discretionary, and financials. Due to this diversified exposure, they offer a relatively low-risk way to invest in the U.S. equity market, ideal for those looking to capture overall market returns without stock picking. Differences. While the SPY and VOO ETFs both track the same index, there are several subtle differences, including their expenses, liquidity, and performance, that investors should understand before choosing between the two S&P 500 index funds. Side by side. Who should invest? These ETFs are suited for investors who prefer automatic dividend reinvestment and a more tax-efficient structure. Both SPY and VOO are excellent options for gaining broad exposure to the U.S. stock market, but they cater to slightly different types of investors. SPY is better suited for short-term or high-frequency traders who prioritize liquidity and easy access to quick trades, and those who may use the ETF for hedging purposes due to its high trading volume. VOO is better suited for long-term investors looking to minimize costs and maximize returns over time through lower expense ratios. Both funds are stable, reliable, and offer the benefits of S&P 500 exposure, making them foundational ETFs for almost any diversified portfolio. To explore other comparisons and gain unlimited access to compare ETFs and other investing tools, subscribe to ETF.com today.